Hopefully some more will join in. You guys are free to ask questions at any time. So pop in as you wish and pop out as you wish. And Kitty will be recording it, and she will send you the recording if you want to re-listen to it. So I am just very glad to have you here to join us for talking about permanent profitability. It's something that I am super passionate about because I just think as an entrepreneur, we work so darn hard that we ought to be able to make money while we're doing it. Because
Angie, you're on mute. You're on mute. Yep.
How about now? Can you hear me now? All right, great. So I'll keep going in my discussion of profit first. All right, so I'm very passionate about building profitability in our business. I started my business myself in 2007, and I was working my tail end off. And I came from a sales background, and I was very good at sales. So I was able to get clients quickly and build up my book of business. By the time 2013 came around, I had 5 full-time employees and lots of clients, and things were going great on the sales side, but I had a terrible time making profit. I just couldn't figure out how to do it. I couldn't figure out how to pay myself and pay all the expenses in my business and still come out ahead. And things got really ugly there for a while. What ended up happening is it came payday, and I needed to pay 5 people and myself. Well, there was no money for myself. So I forego the paycheck, and that had been happening on something of a regular basis, unfortunately. So I was okay with that. But then I went to pay the employees. Turned out I overdrafted my bank account by $34 and change. And I was just livid, because how could I be in a financial based services industry and have an overdrafted bank account when I was trying to pay my employees? So I was just ticked off as to why I couldn't figure out the marriage between sales and paying people and keeping customers happy. But the truth of that is that it's a very difficult marriage. It's not something that's easy for everybody. And so I was really struggling. So to improve my situation, I made another bad choice. I decided to bring in a partner in my business because I needed the equity. I needed the cash in the business. Okay, so I brought in a partner. It was a woman that was working for me at the time, and she was very competent and fabulous person, but we also had very different working styles and beliefs in how we went to market. And so, as you can imagine, that ended up in a lot of fights, and it wasn't a pretty relationship, and the money, it definitely wasn't worth it. So what happened is I had to go through a business divorce, and I managed to do that just after 1 year of partnership with this woman. And so I went back on my own, and at that time then I went back to doing only the business that I could handle. I quit going to the 8 a.m. coffee events and the 5 p.m. cocktail events and building that book of business. I quit all of those things, and I just focused on my deliverables to my clients and what I could do to bring profit to my business just as my own as a solo entrepreneur. And that worked great. Let me tell you, I was making really good money and doing well. But what had happened as over those 5-6 years of constantly going to these different networking events, I had built my book of business, and my phone just started organically ringing. And so as the next couple of years, 2014, 2015, into 2016 progressed, I was like, the clients are coming to me, and once again, I'm getting busier than I can handle on my own. So I need to hire people to support me. This time around, I think I can do it better and smarter because I've kind of taken a step back and I'm feeling refreshed, right? So I was very profitable at that time. I was so profitable that I signed myself up for a business conference. And the business conference happened to be at the Atlantis in the Bahamas. That, of course, influenced my choice in going to this particular business conference because I wanted to go to Atlantis and swim with the sharks and all that stuff. So that seemed like a really cool option. So I signed up for the conference, headed down there. I heard this speaker named Mike Michalowicz. He talked about profit first. It absolutely lit me on fire. I was so surprised and taken aback at how simple the system of profit first is to implement in your business. And honestly, how come I had never thought of it myself? So I headed back home, back to Illinois, and I started setting up Profit First in my business. I immediately became a Profit First professional. I went on to become a mastery level Profit First professional, and I put it into use in my very own business. So we've been running Profit First systems over here at Reconciled Solutions since the end of 2017, end of 2016, early 2017. So there's been a solid 4 years of implementation, and it has been an outstanding change on my business. We'll go over some of those numbers later, how it's impacted my business numbers, but it has turned us from a company that was experiencing losses into one that has astounding profit. So it's very exciting. I feel fortunate to be in that position, though, because 83% of businesses are not in that same position. The Small Business Administration of the United States did a survey for small businesses who are considered to be $25 million of revenue or under on an annual basis. And what they found when they did that survey is that 83% of small business owners are surviving check to check. Only 17% of the people out there are actually able to make it past one payroll cycle. So that's horrible, right? I just can't imagine having to live like that anymore. And I don't want any of you to have to live like that anymore. I want you to be on the 17%er side of entrepreneurs who can manage your business with cash in the bank. And when your head hits the pillow at night, you're not worrying about your business finances. Because I know from my perspective, it certainly kept me up a lot of nights. So surviving check to check, it can mean a lot of different things for a lot of different people. But for me, what that means is you're constantly waiting for your client to pay before you can pay yourself, before you can pay your bills. You don't have enough money in the bank to run your company's next payroll. You might not be taking anything for yourself, and you're experiencing bank overdrafts, poor borrowing options. You might have to borrow on credit card, and we all know that credit card percentages can range from 12% to 28%. So there you are stuck with a 28% APR, and that really sucks the life out of you. It sucks the juice out of you and makes you anxious, keeps you up at night. So those are the things that we want to avoid by implementing Profit First in our lives, in our small businesses. And basically what Profit First is doing is we're taking the old standard, which is sales minus expenses is equal to profit. So we get to pay ourselves after everybody else has been paid in that concept. And we're flipping it around. And we're saying that sales less profit is equal to expenses. If we pay ourselves first and set ourselves up for permanent profitability, then the result is that what's left at the end of the day, we're going to be able to pay our vendors from that. We're going to make better choices because we're paying ourselves first. Okay? So that's what we're going to be talking about, is how to do it. Okay, so there are 4 main principles of Profit First. They follow the same theories as dieting and trying to lose weight. I've been trying to lose weight ever since I had that 3rd kid. Have never been able to quite do it. And there's 4 main concepts that we focus on, right? Small plates is one of them. Putting veggies first, removing temptation, and setting up a frequency and a rhythm in our life so that we are exercising and counting our calories and taking care of ourselves, right? So those same 4 concepts apply to small business. What I'm about to show you is how we can set our business up into small plates, smaller portions. We will eat our veggies first. We will remove temptation, and we'll set up and establish a frequency and a rhythm in our business. So the first concept of small plates has to do with portion control. So we've got this beautiful sushi here, and let's just imagine that we're at one of those sushi buffets where the sushi is going around and you're pulling out the pink plate as $3 and the orange plate is $8 and what have you, and you're just grabbing. I bring my kids there and they're grabbing plates off faster than, it's like speed cycle. So what we do in Profit First is we say, well, what are the plates? What are the pieces of things that we need to have happen in our business to support it? Okay, so there's multiple small plates in a business. We're starting with the things that our money does for us in our business. So the very first thing that happens in an operational small business is that income or revenue comes into the business, right? So what we are going to do in Profit First is to separate the revenue or the income from every other activity that's happening in the business so that we can see how much revenue has come into our business on any given period, okay? We're gonna do this by setting up multiple bank accounts. So we are setting up multiple bank accounts to the tune of 4, so 5 actually, 5, because the income account is one of them. And then we're gonna divide our money into these smaller bank accounts because they serve a purpose in each of those bank accounts. So if all the money is coming into the income account and no expenses are going out of that income account, that's our serving platter. And from the serving platter, we are then going to take a small portion of it and put it into a profit account. We're going to take another small portion of it. We're going to put it into an owner's pay bank account. We're going to take a third small portion of it and we're going to move it over to the tax account. And last, we're going to take a fourth small portion of that money and move it over to operational expenses. And then what's going to happen is we're going to have money in each of those accounts and we're going to pay for the right expense from the right account. Okay, now there's one thing else I wanted you to notice as we look at these 5 bank accounts. That is that from income, we have 4 places the money goes, right? Profit, owner's pay, tax, and operational expenses. Well, 3 of the 4 of those accounts are accounts that are set up to benefit us as the owner of the small business. So as the owner of the small business, only operational expenses is not serving us individually, that's serving the greater business as a whole. But profit, owner's pay, and tax are all serving us as the owner, right? So profit, we can think of that as your shiny new car, your fancy new designer shoes, all the fun vacations you want to take once you're not, stuck in your home for a year. All of those things come out of profit, okay? Owner's pay, that's what we pay ourselves. That's the contribution we pay ourselves to get the work done. Most of us are working entrepreneurs. We're working in the business. We're working on the business. We're very active in our business. Owner's pay is what we pay ourselves, just like everybody else on our staff gets paid. So the owner's pay is used to put food on your table, roof over your head, shoes on your feet. It's your everyday things that you need to live, right? Now, tax, a lot of people argue that tax, Angie, that's not to pay me. But you know what? It actually is to pay you. Paying tax, although I don't want to pay more than I have to, it is a privilege. It's the privilege that is bestowed upon a business owner who is earning a profit. Okay, if we are showing a loss in our business every year, then we don't have to pay taxes. But if we are making a profit in our business, then we do have to pay taxes. And what we don't want to have happen as a business owner, as it comes March or April 15th, when your taxes are due, and all of a sudden you need to come up with 20 grand of cash, and you don't have 20 grand of cash, right? Because you haven't been setting aside for it on a day-to-day basis. So we are able to avoid that through the process of setting up these multiple bank accounts and dividing our portions into smaller pieces, okay? All right, so I want to talk about real revenue. It's different than is total revenue. So I know Susan, for example, has a hairstyling business. So if I come in and have my hair styled by one of Susan's stylists, I would assume that that stylist gets paid for my hair, for my head of hair. Is that correct? Okay, so they're not getting paid by the hour. You're not saying you need to be there from 9 to 5. They're getting paid for Angie's haircut. They're getting paid for Roz's. They're getting paid for Megan's and Kitty's. So they get paid for those multiple haircuts that day. Okay, so that is an example of materials and contractors. Those people that are cutting hair or doing hairstyling, they can be either contractors or employees, but they are only getting paid if they produce results, right? So another example of this is a dog walking business. In a dog walking business, I can have 20 different dog walkers. I maybe only walk 2 dogs a week. Okay, the revenue that comes into the business is based on the other 20 people that are out there walking dogs. And whether I'm paying those contractors as a contractor or I'm paying them as an employee, they are only being paid the portion of what they deliver, meaning they're not scheduled from 9 to 5 or 8 to 3 or what have you. They get paid because they walked 22 dogs. They only walked 10 dogs. They only get paid for 10 dogs. It is variable based on what was collected. So that's what materials and contractors are. In a product-based business, say you're running a bakery, the materials is, of course, your flour and your sugar and your vanilla extract and all of those goods, okay? If you schedule somebody in your business to work from 8 to 3 and they're making cupcakes and cakes throughout that day, that is not a materials and contractors expense. That is an operational expense. So materials and contractors expenses are limited to those things that have a direct relationship to your total revenue, okay? And what we call it when we have total revenue up here, and then we pay our materials and contractors, which is our dog walker and the flour and sugar in the baking business, what's left, what's remaining, that's called real revenue. And from real revenue, we then had to pay those other 4 things that we talked about on the last slide. So just going back, those 4 things, the money is then going to be split. Real revenue is being split between profit, owner's pay, tax, and operational expenses, okay? The next lesson in implementing profit first in your business is to eat your veggies first. It's to allocate first, okay? But obviously in a dieting concept, we need to eat the stuff with the most nutrients first. That's what's going to fuel our body. So that's what we do in profit first. We want to fuel the machine of a healthy operating business by doing those allocations, by saying, okay, I collected a total revenue of $10,000. I need to put $2,000 over here into my materials and contractors account so that I can pay for the dog walkers. And I'm going to have $8,000 remaining. And I'm going to take a percentage of that $8,000 remaining in real revenue. And I'm going to split it between the profit, the owner's pay, the taxes, and the operational expenses. At the end of the day, I had 10,000 up here. I spent 2,000 to pay my materials and contractors. I now have $8,000 of real revenue, and that $8,000 will be divided in total between those 4 accounts, and there will be 0 left. Okay, then the income account, that bank account at the bank where all the money has collected, that has been emptied out. The balance there is a big fat 0, and all the money is now divided into the other counts, and the cycle restarts. Okay, then we just keep building again. So that's what Veggies First is all about. Okay. If you're not sure what percentages you should use, what percentage, Angie, should I allow for operational expenses? What percentage am I entitled to keep for myself as owner's pay? Here are some target allocations that Mike has put together after studying small businesses across the world. He studied small businesses across the world to come up with these numbers, okay? And now your industry might have different percentages. If you are in an industry where it's easily trackable inside like an industry organization that supports your industry, you might be able to get these numbers from your industry organization, right? That professional association that supports people in your industry. If you don't have an affiliation like that, then I suggest you use these target allocations percentages. They are sharp enough that we can all use them and aspire to getting to these percentages. These are very good percentages. They can be challenging to get to. Okay? So I'm going to give you an example, and we're going to walk through it together. So there's a business in 2020 that earned $600,000 in total revenue doing website design and website development. So their total revenue is $600,000 for 2020. There were 5 team members in this organization that's building websites, okay? Of those team members, there was 1 owner, not a partnership, just 1 owner. There was 1 operations manager. That person was a full-time employee to the business and received a salary of $50,000 per year. And then there was 3 web developers and designers. They each received about $70,000 each, and they were paid as subcontractors in the business. So those are the 5 people in the business. We started out with a total revenue for the year of $600,000. And my question to you is how much of that is real revenue and how much is the total revenue? So of those 5 people, the owner, the operations person, and the 3 subcontractors who are paid $70,000-ish each for delivering website design and development, how much is remaining in real revenue? Okay, so no answers being shouted out, but 70,000 per person that's doing the web design and development, those are your materials and contractors expenses. All right, so 70,000 times 3, $210,000 spent throughout the course of the year on materials and contractors. So that means we had a total revenue of 600,000 at the beginning of the year. We paid 210,000 out to different subcontractors, and the remaining real revenue is $390,000. Okay, so now we have $390,000 of real revenue, and we are going to split that real revenue up into our profit, owner's pay, tax, and operating expense accounts. And so we do that based on the dollar value of the real revenue. It looks like in this situation, we're in column B, right? Okay, so we have a real revenue of 390,000, which easily falls into the 250,000 to 500,000 percentages, target allocation percentages. So what that means is if we have $390,000 at the top in real revenue, we're going to split that 390,000 out. So there's 0 left at the end, and we're going to split it into these 4 accounts. 10% goes to profit, 39,000. We're transferring that to profit, okay? Owner's pay, 35%. 35% is $136,500. That's a pretty decent living. Paying yourself $136,500. It's not like you're just, going to Disney World every day and you never have to work again, but we can live on $136,500, okay? So that's what we have paid ourselves in owner's pay throughout the course of the year, and that's going to pay for the groceries on our table, it's going to pay for the roof over our head, it's going to pay for the shoes on our feet, okay? Then we want to save money for taxes because we already know that we've got about 39,000. If we're able to stick to these percentages, we're going to have 39,000 in profit. So we are going to be taxed on the profitability of the firm. We are also going to be taxed on the income that we kept for ourselves, our owner's pay. So that's 136,500. So you have 39,000 plus 136,500. Those are the two things that you're going to have to pay a tax burden against. So we set that up to be about 15%, and 15% of our 390,000 is 58,500. The last thing that we spend money on is the operational expenses. So our operational expenses are going to include that operations manager, right? She had a salary of $50,000 per year. You're going to pay for your advertising and marketing and sales budget out of there. You're going to put paper in your printer. You're going to pay for your computers, all that kind of stuff. Those are examples of operating expenses. Your rent, if you have a business location, is part of operating expenses, okay? We get to allocate 40% of the real revenue of $390,000 towards operating expenses. So in this case, that's $156,000. So what has happened is over the course of the year, we look at what's been collected into our income account. We transfer some over to the materials and contractors account. What's remaining is the real revenue, and then we're transferring it into these other four accounts, right? Based on the percentages, 10%, 35%, 15%, 40%. That adds up to a total of 100%. We have not spent more than we had to spend. We can't spend more than 100%. If we are, we're experiencing a loss in our business, okay? So again, we've got 390,000 up at the top of real revenue. We're transferring over the course of the year 39,000 into that profit account. We're going to go on vacation and do something fabulous with that money. Everyday day-to-day living is paid through owner's pay. So that was 136,500 of it. And the tax was 58,500. So when the tax bill comes, we're going to have money set aside to be able to pay that. And we have $40,000, we have 156,000 or 40% remaining to pay all of our operating expenses, one of which is the $50,000 that is paid to that operations manager. So 156 minus 50, there's $106,000 left in the business. We're going to pay all our other expenses with that $106,000. So that's how it looks when it's arranged out. The next step of profit first is to remove temptation. Obviously, this is the diet analogy, right? We want to get cookies and candy and potato chips and French fries out of our house so that they are available to us when we're craving a big treat. So we want to remove temptation. If you apply that same concept to business, what we want to remove is the ability to spend money based on our bank balance. So if today you're in a situation where you have one bank balance for your whole business, so everything comes into one bank account, everything goes out of one bank account, then it's really easy to overspend because we're creatures of habit. And if we look at that bank account and it's got multiple zeros in it, it looks like a nice healthy balance, we might forget that the rent is right around the corner. We might forget that your phone bill, your mobile bill comes out on the 25th of the month. We might forget that payroll is just a couple days away. And we might instead choose to go out to a fancy lunch with our coworkers. We might instead choose to buy some additional coaching package that's maybe a little bit out of our reach. We might have had our employees, here's a good one. Employees come to you, Angie, I'm so overworked. I can't keep up. You have to hire more help. Okay, that's an example of us saying, oh yeah, money looks good. Let's go. Let's hire another person. Hiring another person is a big deal. We have to figure out if the business can afford to hire another person. And is it still going to be able to afford what I need as the owner to survive? The thing about removing temptation is that if we have it all in these separate bank accounts, we make better choices, right? Because then instead of it all piling up into one big bank account and we can't keep track of all the things and the ways that that money is going to be spent, removing that temptation, and we're saying, oh, okay, I only have $5,000 in my operational expense account, and I know I have to pay for my rent, and my rent costs $4,500 a month. So I really only have $500 left in that account, right? So then we're making different decisions as we make purchases throughout the day, throughout the week, throughout the month, throughout the year. Okay, we've removed the temptation. So making those allocations, while it might appear like an accounting pain in the rear, it's really saving you. It's saving you time, effort, energy. It's saving you from yourself. You're going to be able to make better decisions by removing the temptation. So the fourth and final rule of Profit First is to develop a frequency in how we go to do all these distributions. So typically in Profit First, we have certain days in which we allocate and certain days in which it's time to party and change our allocations and get ourselves a quarterly profit distribution. So typically in most of our personal lives, as well in our business lives, if things fall into a rhythm, we tend to need to pay bills about twice a month, okay? And we're kind of living on that. We're not trying to create a new habit in the frequency of how often we have to look at our bank accounts and pay our bills. Typically, most people, I pay my credit card once a month. I pay my mortgage once a month. The mortgage is due at the beginning of the month. The credit card's due at the end of the month. And there might be some scattered dates in between for my utilities and all this kind of stuff, right? So we settle on a rhythm, a frequency of doing profit distributions or income distributions twice a month around the 10th and the 25th of the month. So that is our 10th and 25th rule. We are gonna wait until the 10th for all the income to collect in our income account. We're gonna divide it up into smaller plates and empty out that income bank account so that the balance there is zero. Then between the 11th and the 25th of the month, the money keeps coming in, and around the 25th of the month, we're gonna divide it into the portions again. Okay, we're just gonna continue that rhythm. So the rhythm is to allocate, to distribute, and to pay bills. That's what happens with our day-to-day bills. But then you've got taxes. That doesn't happen every day, right? There's some things that only happen once a year. So what we do in Profit First is we set up these out of sight, out of mind accounts, removing the temptation, and we only distribute from those accounts once per quarter. So that would be your profit distribution. So if you are in a position where after 3 months of doing business, you have a profit and it's been collecting in that one profit bank account, then you get to do a party time dance and go out and buy yourself something fabulous. Okay. So what I would say about Profit First is this is a mindset shift. It's not necessarily an accounting system. It's just a mindset shift. So in the process of going out and getting busy setting up Profit First in your business, If you are able to allocate successfully and complete that for a whole quarter in your life, that you actually went to the bank and set up all these bank accounts and your banker looked at you like you were crazy, but you did it anyway, and you actually went into that income account twice a month around the 10th and the 25th and split that money up into these other accounts, then by all means, that first profit distribution is 100% for you, and there should be a party. Okay, so because you have changed the way you think about money and you've changed your habits. So the first time around, the very first quarter after you start Profit First, I encourage you to buy something extravagant and fun and completely frivolous with that quarterly profit distribution. If after that first quarterly profit distribution, you're like, Angie, I've got debts. I got credit card debts. I owe my mom $20,000 for starting this business. Whatever it is, you can then take your profit distributions and destroy your debt. Okay. But the first time around, you get to have a party with it. One, because you've actually declared profitability in your business and it's there. The proof is in that bank account. You didn't steal the money to pay for some other bill. You have said, I am permanently profitable. And even if it is not 10%, like it was in the example of the website design business, even if you were only able to squeal away 1% of 390,000, that's still $3,900, and you can have a nice party with $3,900. Okay, so I don't care if what you've managed to squeak away in the first quarter of implementing Profit First in your business is $10, or if it's $10,000, you have declared your permanent profitability. So you're going to have a party with that. If it's $10, you're going to go to Starbucks and order the one with all the calories and sugar and have yourself a little dance in the corner. And if it's 10,000, well, there's a few more options for how you're going to spend that money, right? But you're going to have yourself a party after your first profit distribution. Second, third, fourth profit distributions, those can all be used for more practical purposes. But the first one is all for yourself. And I would just say that for most small businesses, it takes about 18 to 24 months to get to your optimal allocation percentages. So just because the spreadsheet I showed you says that you should have a profitability of 10% and you should have operating expenses of 40% doesn't mean that you actually do, okay? What you can do is just start with that profit account, 1%, and each quarter then we are going to change our percentages. So that's the last bullet on my slide here, the quarterly cap real allocation. So if for the first quarter, you decide that all you can afford to put in your profit account is 1%, and the other 99% of it has to go to operational expenses, that is fine. You have declared 1% that goes to you as the owner. The other 99 can go to the rest of the business, and you're still going to have a party with your 1%. Okay. What's going to happen is you're going to think, this sucks. I should be having a $10,000 party and I'm only having a $10 party. And you're going to look for ways to cut back and to change your operational expenses so that you can improve your target allocation percentages and your current allocation percentages. So maybe you only started with 1% profit in quarter one, but in quarter two, you move that up to 2%. And in quarter three, you go up to 3%. And each quarter, you're making improvements on the way that you do profit or the way that you do business, improving efficiencies, improving headcount, finding new ways to go to market, maybe raising prices, maybe finding a different supplier. And each of those acts is going to result in those percentages allowing you to have a more fulfilling business. So I just want to remind you of that 10th and 25th rule. I know a lot of businesses that do their target allocation percentages or current allocation percentages, they do them once a week. So if you're in a business where payroll happens once a week, you maybe want to do your distributions once a week. If you're in a business where payroll happens twice a month, then maybe you want to stick to the 10th and 25th rule. That's really up to you. But as in dieting, as it is in small business, that rhythm is what's important. So we need to exercise every day to lose weight, and we need to counter calories and be at a calorie deficit. The same thing happens in small business. We need to exercise that practice of building the money in your income checking account at the bank and then distributing it to the other accounts throughout the course of the month. Okay? So I know when the first time this was explained to me, it was pretty terrifying for me because I was not one of those people that had the self-discipline to be able to manage that big bank account money. And so I was absolutely terrified to set up all these bank accounts and make these transfers. But I just want to remind you that that's completely normal. You need not have fear about it because you're good enough, you are smart enough, and doggone it, people like you. We've got Stuart Smalley telling us there that people like you and you can do this. And it's absolutely normal to have a little bit of fear about finding out what your actual percentages are and how you've been doing business. So don't let that threaten you. Just get to the math and make sure you understand every number and every way that you spend money in your business. So if you want to get started on Profit First, the first thing that you can do is to get your butt to the bank. Okay, when you go to the bank, you are going to open these different bank accounts and you are going to declare permanent profitability. And like I said, I don't care if you had a $100,000 loss in your business last year, or if you had a $100,000 profit in your business last year, you can go and get that profit account set up. And at minimum, you can start dripping 1% of your real revenue into that account. Okay, so just go get it done. It's not a terribly difficult thing to do. You're going to be setting up an income checking account, a profit checking account, owner's pay checking account, tax and OPEX accounts. Then, if you really want to go all in, you are going to drive your butt to an inconvenient bank, one that you have to work harder to get to, and you're going to set up a savings account over there for profit and one for tax. And the result of those two accounts is that you're squirreling the money away, out of sight, out of mind. You're removing temptation so that when that tax bill does come and you did have $100,000 of profitability in your business, the tax money is going to be prepared and you can send it in and do yourself a little happy dance that you're not scrambling to come up with $20,000. Okay, so that's what it's all about. What we are doing then is we are always taking our profit first. So now this whole equation that I gave you before that I said, in typical GAAP accounting, generally accepted accounting principles, it's always been sales less expenses equals that profit for us as the business owner. Now it makes sense. We can do sales less profit. It's going to be equal to our expenses. We are going to spend only what we have available after we've paid ourselves. So we are focusing on what comes first. And what comes first is the health and wellness of ourselves and our business, because none of us are at our very best position in life or supportability when we are anxious and scared because we don't have enough money. That lends itself to bad choices and stupid mistakes. So if we focus on what comes first, making sure that we are taken care of as the business owner, we're going to make better choices. We're going to have less anxiety, less stress on our lives. We're going to be able to sleep better at night. There's this law called Parkinson's law. I'm sure many of you are familiar with it. It means that our demand expands to meet the supply. And that applies in Profit First, because now we have this account that's set up for the expenses to come out of. And if there's not enough money there, you might not choose to spend your money that way. If there's a lot of money there, you might decide that, yeah, I can afford to buy that extra thing that I want to buy. So think about it like a tube of toothpaste. If you go get a tube of toothpaste from your medicine cabinet and go to brush your teeth in the morning, if that tube of toothpaste is brand new, you're going to slather the toothpaste on there and get to brushing your teeth. Over the course of time, you're taking that tube out of your medicine cabinet every single day, and there's getting to be less and less toothpaste in the tube. So towards the end of the tube, you have to work a little bit harder to get your toothbrush covered in toothpaste. You're going to squeeze that tube a little harder, you're going to push a little harder, and then you're going to brush your teeth. And at the end of the day, your teeth are just as clean on day one of the tube of toothpaste as they were on the last day that you can utilize that tube of toothpaste. So our demand in this case has expanded to meet the supply. When the tube of toothpaste was new, we put all kinds of toothpaste on there. At the end of its life, we are squeezing out every little bit remaining, and we are still getting clean teeth as a result. So that's how we relate it to Profit First. We're going to get every dollar, every penny, every expense that we can out of the amount that's in our expenses account. Now bank balance accounting suddenly works. We are able to leverage the behavior instead of just seeing that we pull up our phone, and on our phone, I've got $20,000 balance, all is good, I can afford whatever I want. Now I look, and that 20,000 is divided into 5 accounts, and I might have a different reaction. Holy moly, I've only got $2,000 left in my expense account, in my operations expense account, and I know that payroll is next Tuesday. I better get to work. I better get some more money in this account. Okay, so bank balance accounting is now working. We have leveraged the behavior and just changed our habit. Okay, so that's kind of the end of the presentation. I do want to point out 2 things. I'm going to go back to this slide just 1 second. So in our businesses, especially in this difficult time of COVID, people, they're worried about their well-being, right? And one thing that I can say about worried about our well-being is that we can only afford to take what our business can afford to give us. And our business has to be profitable. So I've been working with all these different business owners over the past year, and we've been cutting expenses, because we didn't need them in this environment where there was less customers available for us. And that's exactly what we should be doing. That way we can still maintain our profitability, because we are important in our business. We are the ones that are employing other people and driving the business forward. So there are only 2 ways that we can improve profitability in our business. And I just want to verify what those 2 ways are, because a lot of people think, oh, I didn't make enough, I didn't sell enough. Isn't that a common thing? I didn't earn enough, I didn't sell enough. I have to sell more, that way I'll make more money. But the reality of it is that selling more is no guarantee that you're going to earn more. What is a guarantee to improving profitability is to increase your margins and to cut expenses. So just because you have more in sales doesn't mean that you're going to be more profitable. You still have to increase margins and cut expenses. Those are the only 2 ways that we can improve our profitability. So in this environment of disaster relief, we have to understand that our expenses have to reflect what is available to spend, okay? And that is your income. And some of that income may be coming from disaster relief, or we may be able to hustle and regain the sales that we lost during COVID. But either way, if we want to maintain profitability for ourselves, we have to cut the other expenses in the business first before we cut our own profitability out. That's the way we keep a healthy business. And we improve profitability only in those two ways, through improving margins and through cutting back on costs. Is there any questions? All right, Roz, you got a question.
So how does it work with the, say, QuickBooks, with the multiple banks, especially on the saving on the inconvenient banks?
Yeah, well, it's not a problem at all. I mean, the amount of time it takes for your bookkeeper to do that is not a problem. I mean, think about it this way. All the income is coming into one account. So they can only question like who this money came from, not why did money come into the business. All the expenses are going out of their appropriate account. So if your bookkeeper at the end of the month is saying, what's this expense for? What's that expense for? It might make more sense now that it is in a separate account.
Mhm.
Because, for example, you paid for something from the business that was actually a personal expense. Well, if you paid that from your owner's pay account, then chances are your bookkeeper is going to know, oh, that was Roz. He was out buying a fancy dinner for his girlfriend again, and that's a personal expense. Versus if it would have come out of the account where everything was happening, they might be, oh, was this business? Was this personal? I'm not really sure.
So the checking should have the operational expenses account, right?
Mm-hmm.
Okay.
The first account that you are, if you have one account now, what I'm going to say, if everything is flowing in and out of one account at this point, the first thing you can do is to declare that one account that you currently have, that's your income account. And I'll tell you why you want to declare that one as your income account, because we don't want to mess with payments. If people are paying us by ACH or there's credit card processing involved, all of that is tied to that one bank account that you set up. And we do not want to mess with income coming into the business. That's our gift. That's what keeps our business alive. The better choice is to set up a new bank account for your operations expense account. And then that's really fabulous too, because as you're going through and calling your vendor, let's say you're calling your credit card vendor and saying, hey, I need to set this up on auto pay from this bank account, not from that bank account. You also at that same time might say, hey, you know what? I don't really like getting my bill on the 18th of the month. Can we move this to the 28th of the month? It would help my cash flows better if we moved it to the 28th of the month. And if you're going through your expenses that are being auto pulled from your bank account, and so a lot of people pay their utilities on auto pull. A lot of people have gym memberships on auto pull. A lot of people pay their mobile phone and dues and subscriptions out of their checking account. Those things happen automatically without them thinking about it. So now you have to call each one of those vendors and you have to say, hey, I got a new bank account. You have to switch it to this. And in the process of doing that, you might say, you know what? I'm not really using that whole software package. I only need, there's a small, medium, and large in every software package. So maybe you're signed up for the large, but you're actually only using the benefits of the small package. That happens all the time, right? So this is your chance to reinvent yourself and to say, hey, I don't actually need that. I'm going to cancel that expense, or I'm going to change it to the small instead of being on the large. So it's your chance to go and cut some expenses out of your life.
Okay, interesting. And now when we look at QuickBooks, say to see the income, it would still shows as normal, right?
Yeah, your profit and loss looks the same.
Okay.
I will tell you that all of my clients' balance sheets look way better than they did a year ago. We've got so much more cash on hand because of these different accounts. So it's really powerful. Even for the businesses that have struggled in COVID, I will tell you that their cash position is higher. And I am not going to say that it's 100% because they got some government federal stimulus money. I just absolutely do not believe that, because their cash is higher because they have been more thoughtful in their spend. And they've decided that, holy cow, what happens. It happens, right? And I need to have a little set aside for a rainy day. So I'm not going to take every last $10 out of this bank account and leave me with $5 left in the account. I'm going to keep 1 month's worth of expenses. My preference is 3 months worth of expenses in your bank accounts. But we work to that slowly, just like we improve those percentages one day at a time.
Okay, interesting. And payroll will be out of operational expense, right?
Yes, payroll would be out of operational expenses typically. And
Okay,
typically there's only one payroll account, like all payroll, whether it's a contractor or an employee, is getting paid out of one payroll account. The provider can only link it to one account. That doesn't mean you don't need those other accounts. We still do the multiple transfers because it's a thought process shift, right? This money's for me, this money's for my payroll, this money's for this, this money's for that. It has a purpose.
okay, yeah, that's what I have currently. I have a separate payroll, which is connected to the payroll company, so that I can leave. And okay,
Cool.
yeah.
Angie, do you have advice about what bank to use to set up like fee-free accounts?
Yeah, I have a list that we can send. So like I said, we are going to be sending out a link to this presentation. And I do have a Profit First friendly list of banks, and it's divided by areas of the country. So it's got a Midwest section. I bank here in the Chicago market at US Bank, and I think they're great. They allow me to have all these different accounts. So I've got 6 different accounts over at US Bank, and I don't pay any monthly fees. And that $15 a month, a small business, that adds up. 15 times 6, it's significant. You don't want to do that month after month.
Yeah.
So I will send that PDF along with the link. Okay.
Yeah.
All right. So repetition becomes habit. I think we've made that very clear. There's steps you can take today. If you're not comfortable with your numbers and really identifying, is this probably the single biggest thing I hear, is this a materials and contractors expense, or is this an operational expense? And the other one I hear is taxes, 15%. Do I really need to save 15% for taxes? What is my true tax burden? So what I encourage you to do is to take the next step and fill out this free instant profit assessment. So we will be sending this link to you in the follow-up email, and you can register for an instant profit assessment. You're going to go through your own numbers, you're going to do your own calculations, and then you're going to schedule a time with me. You get a 20-minute one-on-one with me, and we will review your numbers together. And if you have any of those questions that you're confused by, what's this, what's that, what bucket does it go into, we'll get those issues cleared up for you. Okay. And then the other thing that I'm offering is a group coaching. We just finished with the second cohort, and I have a third cohort starting on March 23rd. And what we're doing in that cohort, it's specifically designed for professional services-based firms that are exchanging knowledge for money. And it's for businesses that are typically 1 to 3 years or so in business. And we are marrying the concepts of compliance and tax and being, compliant with GAAP in a QuickBooks Online company file with the concepts of profit first and setting yourself up for permanent profitability and manageability. The ideal candidate for the group coaching is somebody that is managing their own books and wants to know better how to do that. But I would say that we have had plenty of people that also have a bookkeeping service in this class, and they get a lot out of it, because the truth is, a lot of business owners can't quite get down to the nitty gritty and understand their profit and loss and balance sheet with true detail? Do they know what every single line on the profit and loss and balance sheet signifies in their business? And we will make sure you do by the end of this course. Okay, so those 2 links will be there for you. And we're here for you too. Here's some different ways to contact us. Do we have any other questions? Okay, so I think we're good for today, and I'm ending, 1 minute past the hour. I just wanted to encourage you to draw your line in the sand today and to set your business up for permanent profitability and to never look back on that.
That was very interesting, Angie. Thank you.
All right, take care.
Thanks,
Thanks for
Angie.
coming.
Appreciate it.
Thank you.